All right, well, if you're just joining us, if you could put your name and where you're from in the chat, I'd love to see where everyone's from. I think we can get started, right? What do you think, Bruce?
Here we go.
All right.
Good afternoon, and thanks for joining us for this edition of AARP Massachusetts Fraud Talk Tuesdays. We are here the second Tuesday of each month from noon to 12:30, where we discuss a different scam and how you can protect yourself and your family from becoming a victim. My name is Bruce Farrell, and I am a volunteer with AARP Massachusetts. And our guest today is Andrea Bob Stark, a senior attorney with the National Consumer Law Center in Boston. Today, Andrea is going to provide a basic primer on what home equity investment HEI loans are, including the risk and consequences and also policy recommendations from the National Consumer Law Center. You may have joined us today with questions already in mind. If you have, please put them into the Q&A at the bottom of the screen, or if questions come up during the presentation, put them into the Q&A. This session is being recorded. You will receive a link to the recording that you can share with family and friends. At the end of the presentation, we will have a page with links to a number of resources, which will also be sent to you. So, Andrea, and some of the information you provided us on equity investment loans, you put the word investment in quotes. Can you describe what home equity investment loans are and why the word investment is in quotes?
Sure. Thanks, Bruce. And thank you, everyone, for joining us today. I'm really grateful that I can be here to talk to you about this very risky product that a lot of you or your clients might be coming across in the next several months. These products are on the rise, and we really want to make sure advocates working with older adults and older adults themselves understand what's at stake here. So what we have are home equity. These are called home equity investment loans. We do put the investment in quotes because they're really not an investment for homeowners. They are an investment for creditors, as you'll see. They're quite a good investment for creditors to take advantage of homeowners, but they're not an investment for homeowners. In fact, it's equity theft and not an investment at all. And so we see that these products come under different names, home equity investments, which is what we'll refer to them as, but you may have heard of them as shared appreciation mortgages or SAMs, home equity agreements, home equity option contracts. No matter what you call them, it is home equity theft. We're going to explain that today. And I'm curious, if you just put in the chat yes or no, have you heard of any of these products? Or any of your clients or you seeing these products? Yes or no, shared equity, this shared appreciation mortgages or the home equity investments. Okay, so it's interesting. Most of you know Sherry has, but a lot of you are saying no. These are the companies that that offer these products. These are some of the companies. The one that is in Massachusetts is Blue Hub Capital. Also, Unison has come to Massachusetts. So you might be hearing about these products. They are nuanced. They're not all a cookie cutter product. We're going to go over what the main terms of these products are, but these are some of the names of the entities you might hear in your state, either directly or with people that you're working with. So if we go to the next slide, we can talk about the big picture. So some of the common features that are included in these home equity investment loans. And like I said, there are nuances to them, but they do offer a lump sum cash in exchange for a future share of the value of the home. So a lot of homeowners are getting a postcard, and the postcard says, we will give you tens of thousands of dollars of cash up front. You don't have to pay us any monthly payment. And in exchange, in 10 or 30 years, you'll have to pay us a percentage of the value of your home. And so they target cash poor, equity-rich homeowners. Homeowners like older adults who have a lot of equity in their home. And then the payment comes due in 10 or 30 years, or when they sell the home or refinance the home, or one of the borrowers pass away, then they're hit with 20%, 50%, 70% of the value of the home that they have to pay to these creditors. So that's the big picture of how these work.
Andrea, now that we know what they are, what are the most common tactics HEI lenders use to market these products to older homeowners?
If we go to the next slide, we can see some of the sales pitch that they will use. They will say, oh, no monthly payments like a traditional mortgage. You don't have to pay us until one of these events happens, the end of the term of the loan, or you sell, or you refinance. And there's no impact on your credit. We're not going to do a credit check. It's purely based on the amount of equity in the property. So it is an equity-based product that does not take into account any ability of the borrower to repay that amount. They say that it's not a loan. This is not a loan. It's an option contract, and we'll come back to that in a minute. They say you're not taking on any new debt. This is just using the equity that's in your home, and there's no interest, which is misleading, because at the end of the term, when they have to actually pay out money in that lump sum to the creditor, it equates to an extensive amount of interest that has been accumulated. And there's no income requirement. So it's not the burden that a traditional mortgage application would have. Next slide. But these are fraud. Let's get that straight. That the homeowner relies on these false misrepresentations by the creditor to con them into these loans. And then in the end, they are drastically financially harmed. In order to make that lump sum payment of the value of the home at the end of the loan, most of these homeowners will have to sell their home and be left with very little to move into assisted living or downsize or a new home. Yes.
Andrea, many of us have heard the terms reverse mortgage or home equity lines of credit. So how do these HEI loans differ from those?
So next slide. Yes. So I saw Carol had the same question. Good question. So I've done a chart here, and you'll get these slides after the presentation. And it really goes through how HEI loans are different from reverse mortgages. They are similar. And so if you have somebody coming to you with one of these HEI loans, you really want to say, would a reverse mortgage meet your goals? And would a reverse mortgage be a better option with more safeguards in place for that person? So HEI loans are fixed term, usually 10 or 30 years. Reverse mortgage, it lasts as long as the borrower lives in it or their spouse lives in it. And HEI loans can be given at any age, whereas reverse mortgages, you have to be 62 or older. For HEI loans, the payment is based on a percentage of the home value or appreciation in that value when the loan term comes due. And the reverse mortgage has a set interest rate. So the homeowner will know how much is due when. It's not the same for the HEI loan. When they enter into that loan, they have no idea how much they're going to owe in 10 or 30 years, because they have no idea how much their home will be valued at, or no idea what their home will be valued at, and what the value of that home will be to determine what that 20, 30, 50, 70% share will be. HEI loans they claim they're unregulated. They are loans. We argue they should be regulated under traditional mortgage statutes and consumer protections, but they say they're not loans, and they argue they're not regulated, whereas reverse mortgages are very well regulated. There are a lot of rules and provisions in place, HUD certified housing counseling required, making sure older adults understand what they're getting into. So you get the gist that HEIs are pretty much unregulated. They don't have a fixed, they don't, it's not based on any age. And you can't calculate the amount of money that's going to be due at the end. There's no way to know that. Whereas with reverse mortgages, it's much more structured and there are a lot more protections in place for borrowers.
Thank you for that, Andrea. Why are HEI loans often labeled as option contracts instead of loans? And what legal implications does this have for consumer protections?
That's a good question. I really want to go into this because it's a little complicated, but I do want to answer Rosalind, who said, how do they differ from conventional home equity loans? And they differ, HEIs are different because in a home equity loan, there are a lot of protections, regulations, consumer statutes that come into play that require disclosures, that require certain caps on how much interest can be charged, require monthly statements, require the borrower to know exactly how much they're going to owe and repay, whereas these home equity investment loans provide none of that. So I just wanted to clarify that. And reverse mortgages are different from home equity lines of credit. Home equity lines of credit don't have an age requirement, and it is based on the equity in the home, but there is also some ability to repay evaluation going on, looking at income and ability to repay. So again, more safeguards in place under these traditional mortgage products, unlike these HEI loans. So they are, the HEI industry, creditors want to call these option contracts because then they're not considered loans under the technical term of loan under the Truth in Lending Act or the Real Estate Settlement Procedures Act or these statutes that protect borrowers when they're taking out a mortgage loan. So they say, no, we're not loans, we're not regulated by these. We say, yes, these are loans. They have very much the same characteristics as a mortgage loan. But they say it's an option contract, which means that they give money up front to buy an option to purchase a percentage of the home in the future. So they'll give $30,000 now to a homeowner for a 50% stake in the home's value in 10 years, for example. That's just an example. And at the end of that 10 years, the investor can say, I'm exercising my option to take that 50%, and the homeowner has to pay it. And most of the time, the only way they can pay that is to sell the home. So they are forced to sell the home. And because they have to pay 50, sometimes 70% to the creditor, they're left with very little to buy a new home, to move into assisted living, and to account for the remainder of their lives and provide a secure housing situation for them.
Andrea, when it comes to purchasing anything, it's important to carefully read the fine print. What are the hidden costs or interest rates associated with HEI loans that borrowers should be aware of?
So there are quite a few hidden costs or misrepresented costs. They say no monthly payments. They say, no interest, but the homeowner still has to pay property taxes, insurance, upkeep for the home, maintenance of the home, just like a reverse mortgage. This is very similar. They have to pay that directly, but they're not told that up front. It's not fully disclosed that no monthly payments doesn't mean the actual monthly payments you still have to pay. A lot of homeowners who had a traditional mortgage were paying their taxes and insurance through an escrow account, and the mortgage servicer would pay that for them. But with these, if they don't have a traditional mortgage, first mortgage that does that, then they're going to have to pay those costs directly. There are also closing costs. So the example we had before with the $30,000 cash lump sum given to the homeowner, the creditor will take probably about $5,000 of that in closing costs. And so the homeowner really only gets $25,000 upfront. And so there are definitely hidden costs. And the biggest hidden cost is the balloon payment that's due at the end. When the term ends in 10 or 30 years, the balloon payment can be huge. It can be 20% APR interest rate, equate to about a 20% interest rate or more. So a $35,000 upfront lump sum payment could result in just 5 years to the borrower owing $85,000. So if a homeowner took the lump sum, decided I need this to make a move, to go into assisted living, in 5 years, they decide they want to downsize or move into a senior residence, then they're going to owe $85,000 to that creditor. I mean, this is how much this can balloon in just 5 years. Imagine 10 years or 30 years. The homeowner is going to be left with very little money at the end, and all of their hard-earned equity is going to go to the creditor.
Andrea, is there anything that can make these HEI loans unaffordable?
Absolutely. So again, I keep saying that final payment at the end, either the balloon payment or the buyout, as they call it, it's uncertain. When the homeowner signs that dotted line on these contracts, and by the way, these contracts are 75 to 100 pages long. They are complex contracts that we as lawyers have taken hours and hours of time to scrutinize and understand and sort through, and we fully don't understand it still. Like, can you imagine a homeowner at a closing trying to go through this huge packet of documents? Anyway, when they sign that dotted line, they have no idea what they're going to owe. They just know they're getting this $30,000 in cash that they need now for medical bills or home repairs or whatever it may be. They're in desperate straits to get this cash to help them out financially. And so it's a huge risk that it will be quite unaffordable in the future to pay this final lump sum. And most of them cannot repay without selling their home and being displaced from their home. And there are also hidden costs, complex terms. The list goes on about how many hidden costs are in this. One example is the appraisal that's done at the beginning to determine the value of the home can be depreciated by the creditor. So if your home's worth $100,000, they can depreciate that to $75,000 as the starting point to assess the value at the end of the loan. So at the end of the loan, if your home is worth $100,000 still, they still make money on that $25,000 appreciation. So there are all these hidden terms that they put in place to make sure they don't lose a dime.
Andrea, are there any other significant financial risks for older adults who enter into HEI loan agreements?
Yes, I mean, we've gone over quite a few. The forced sale is a big one. Risk of losing retirement security. So for a lot of older adults, the home is their security blanket. It is what they're going to use to be able to go into assisted living or transition to another housing option or stay in their home and use the equity with a reverse mortgage or another type of product to stay in the home and age in place. But these products force them to sell because they have to pay out the creditor. It's also hard to budget, especially for older adults on a fixed income, to know exactly how much that repayment will be. They have no idea. And so it's very hard to budget. And then the terms are just so complex that older adults anybody has a hard time understanding what the terms are and what is financially expected from them in the long run.
Andrea, thank you for all that information. Are there current state and federal laws that can protect homeowners from the risk posed by HEI loans?
Yes, we say, and increasingly courts are saying, these are loans. These are either reverse mortgages or traditional loans under the Truth in Lending Act. So that requires clear disclosures and terms. It requires the disclosure of the APR or the interest rate that's going to be charged and what that maximum final amount might be when they enter into the loan. The Real Estate Settlement Procedures Act also would govern these loans, again, providing timely disclosures. And also, if somebody cannot make that lump sum payment at the end, what are some of the other efforts that can be had, loss mitigation efforts to keep that person in the home other than selling the home? The Real Estate Settlement Procedures Act requires loan servicers to look at those and evaluate those with homeowners. As I said, the industry doesn't agree that these laws apply, but we feel there are very strong arguments and now case law that indeed does say that these laws apply to these loans. And on the state level, if you change the slide, the next slide, please. Oh, I think there, oh, did we take, okay, so I will say on the state level, Massachusetts is doing quite a bit against home equity investment loans, and there is a resource page at the end of the document that provides resources for a current bill that is pending at the legislature. We would love your support on that helps regulate these loans, puts a cap on the amount that creditors can receive at the end and protects homeowners. The Attorney General's office has a lawsuit against one of these entities that just survived a motion to dismiss. And the Attorney General's office is also promulgating regulations around these loans. So a lot going on in Massachusetts. We would love your support around that as well. And like I said, those are at the end in the resource page.
Andrea, why is it important to require pre-closing counseling with a HUD certified housing counselor for HEI loans?
Well, just like reverse mortgages require HUD certified housing counseling, these HEI loans are even more complicated than reverse mortgages, and they don't have any specific regulations and requirements in place yet for them. And so having a HUD certified counselor who can go through the terms and really caution the senior or older adult about what might be in store for them at the end of this loan is extremely important. Also looking at alternatives. Is a reverse mortgage a better option? Is a home equity line of credit or loan a better option? Also allowing for financial assessment and budgeting, helping the older adult realize, is this a good option? Can I afford a different option, a better option that might be more regulated and protective? And then also to help them avoid scams and these predatory practices, and to really shine a light on what these loans are all about and what the consequences of these loans could be for that older adult.
Thank you for that, Andrea. What are the key takeaways from today's discussion that everyone should be aware of if they consider a home equity investment loan?
So obviously these, as I've said many times, these are deceptive, misleading, they're predatory loans. They have misleading marketing, cash now, no monthly payments in this fancy shiny postcard. We've decided that you have enough equity and you should use that equity. And they do target older adults who are on fixed incomes, who have a lot of equity in their home. But the final debt, the final payment is not known. And that is a huge wild card that can send older adults out of their home and into turmoil financially and with their home security, erode their retirement security, and also loss of generational wealth, loss of their home, and other options that might be available. And there is a strong need for knowledge, education, and advocacy around these products.
Andrea, thank you for all this. Let's take a look at the resource slide. Any comments on the resource
So
slide, Andrea?
yes, absolutely. So these are great resources. The Consumer Financial Protection Bureau did a really great spotlight on these loans in January of this year. We also have I guess I didn't really say what I do. So anyway, I'm a senior attorney at the National Consumer Law Center, and I work on, this is one of the issues I work on in the home preservation unit and foreclosure prevention unit. And so we have a bunch of articles. We have what states can do. We have an issue brief. We have an article that talks about what courts are doing. And so these are really important resources to learn more about home equity investment loans. And I do think there is an additional slide on the Massachusetts resources. Is there? Not sure if that got in yet, but if it hasn't gotten in, we can certainly provide that, because there are lots of opportunities in Massachusetts to get involved.
Thanks, Andrea, for all of this valuable identity theft information.
I might add
Education.
here, Bruce, I might add here that one of the campaigns that AARP is putting out is this notion of pause, reflect, and protect. All of the things that Andrea talked about. Before you make any of these decisions, pause, wait. Nothing is so important that it has to happen right away. Reflect. What are they asking you to do? And protect. Protect by talking to somebody, perhaps a lawyer, perhaps a friend, before you make any decision. So pause, reflect, and protect. And this goes for any type of fraud or scam that you think might be out there.
Yes, great approach. And I would definitely endorse that. Thank you.
So Andrea, perhaps are there any other questions that we see in the chat, the question that we want to focus on here? Let's see.
Yeah, if anybody has a question, please put it in the chat. I think I addressed them as we went along, but if there are any new questions, I know these are very complicated products, but when you boil it down, it's pretty simple. That these creditors are trying to scam homeowners into giving them their hard-earned home equity in exchange for a much lower amount of cash upfront. And they're using tactics of misleading terms, like no monthly payments, no interest, cash now, you don't have to do anything. But if it sounds too good to be true, it usually is.
There are several things in the chat. We'll be able to get copies of the notes. Yes, you will. What do bank and credit unions and mortgage, that keeps on jumping around, holders say about these contracts?
So traditional banks, credit unions, traditional mortgage products, I'm not sure if they're going to join us in saying that these are loans and should be regulated. I would tend to think they would. We are seeing state regulators, like in Maine, for example, the state regulator is coming out with an advisory opinion that these are loans and are regulated by the state mortgage laws. I would imagine the industry, the banks, credit unions who are providing traditional mortgages or reverse mortgages would also want to see that, because if not, it just encourages unfair competition for them. It encourages these entities to go out and provide these types of loans that they say are not regulated and don't have to follow any rules. And while the traditional mortgages have to follow quite a few rules, and that costs money and takes time. And so I would think they would be very much in favor of having these loans also regulated to prevent that unfair competition.
Thanks, Andrea. Bruce, you want to wrap this up?
Sure thing. Thank you, Dennis. Thank you, Andrea. And everyone, thank you for joining us for today's edition of Fraud Talk Tuesday. Please join us next Fraud Talk Tuesday, which is the second Tuesday in November. The date is November 14th, when we will discuss government grant scams with a representative from the FBI. And remember, if you can spot a scam, you can stop a scam. Thank you all for joining us today.